Good morning, folks, and welcome back to Almus Market Mornings. The focus yesterday was squarely on the Fed's interest rate decision. Rates were kept unchanged, but this time there were a few changes in the wording of the statement. One prominent aspect was Fed using the word elevated to characterize current inflation. Earlier, the word was somewhat elevated. This, of course, reflecting the price pressures due to energy price rise post the Iran-US conflict. There were four dissents this time, one dissent for not cutting and three for including an easy bias in the tone. But let's understand this in detail. Good morning, JK. What's your key takeaways from this FOMC?
Good morning, Swaraj. I think this Fed meeting was significant in many ways. Not necessarily from the monetary policy perspective. There are so many aspects to it. Of course, monetary policy is a key focus of the market. But this was the last meeting that no, Powell was chairing, and he clearly said that I won't speak to you next time. That is how he ended the meeting. And then he also welcomed the new incumbent Kevin Warsh and wished him best, which means it's very clear that Kevin Warsh is going to take over. He also indicated that he is not going to move out of the federal board. He will continue in the federal board. He gave no indication whether he will be taking a decision to quit after that. He acknowledged the fact that the legal proceedings against the Fed had been dropped, and he was going to continue. As for the monetary policy, it is very difficult to clearly take away anything, but definitely, overall, tone indicates that the more caution is, seeping into the monetary policy statement and approach. Like Powell, on the one hand, said that there could be a move away from easing bias as early as next month. And what happens in the next 30, 60 days could change things. So now what you could take away from this is very left to you. But I would presume that, the Fed could be preparing the ground for turning hawkish. But as of now, the easing bias is still there. And that is where the number of dissidents rose. At 4 is the highest number of dissidents that we have seen since 1992. So I think Fed has actually, I feel, missed the bus because inflation is clearly on the rise. Market yields rising is also clearly showing that what the market perceives, where the market perceives to be the monetary policy, and they have refrained from adopting even a neutral bias. So I think there is fears that 2022 can be repeated when they presumed that inflation was going to be transitory and they don't want to hurry into a hike. And if that is repeated, it's going to be very tough market as far as the bonds are concerned. Because suddenly there can be a spate of rate increases, particularly if the war continues for some more months and the inflation does not come down. So the key takeaway for me is, Fed is perhaps now lagging behind in their forward guidance. Of course, Powell might have maintained kind of a safe stance because what he says may not matter as Kevin Warsh takes over. So the all importance now goes into the June meeting when Kevin Warsh will be the chair of the FOMC. And also, let's not forget that most of the central banks are also in a similar position. Like yesterday, Bank of Japan, they indicated that rate rises are required, but they don't want to do it right now. They don't know when they have to do it. They also at the same time put up growth projection as well as the inflation projection, which clearly shows that monetary policy has to rise. We had even indicated about the deeply negative real interest rate, but they are not ready to act. And most in their mind is the impact of the current ongoing Iran war and the higher oil prices, which will impact the economy. So naturally, the yields in Japan have gone up despite their not being ready to hike the rate, as well as the Japanese yen has now weakened above 160 and staying comfortably above 160 as well. Now, on the war situation itself, the decision by Trump not to respond positively to Iran's proposal, or rejecting Iran's proposal that keep aside the nuclear talks, then we will open the Hormuz Strait, that was rejected. And on the other hand, Trump has actually been discussing with major oil companies as to how the oil market can be kept stable. If he has to keep the ships blockade for much longer. So these statements and the continued stalemate was enough for oil to move to a new cycle high. It rose more than 10%, closed above 120. Now it's definitely one of the largest moves that we have seen, and it is the longest streak of rise in the oil that we have seen, eighth session in a row. And there are no signs that it is ending, and no conditions are changing for that oil price high rise to stop as well. So there are also some indications that there can be one more attack from US. So nothing is really comforting as far as the war situation is concerned. So oil price rising to new high in this cycle is not surprising. Now only market hopes that we don't go to the previous high of 149, which was seen in 2008. So that could be very damaging for most of the economies as well. Now, biggest impact came on bond yields. Treasuries were hammered. 2-year yield went up by 10 basis points, 10-year almost 8 basis points, and 30-year almost, just traded below 5%. Crude futures and the gilt futures, or rather the yields in the UK bonds, went up above 5%. This is the first time after 2008. And in UK, it's not just the fear of inflation, but also the political, instability or perceived political instability, which is leading to sell-off in the bonds. And of course, in Japan, we already know that the inflation is higher and the central bank is not acting. Europe is also facing a tough situation while inflation is higher and is expected to go up further. At the same time, economy is not doing well. So market is not ready to hold the bonds. That is where the fresh sell-off is coming. Now, is this if you look at the technical charts of the yields, I feel they are headed much higher. Yields are headed much higher. And the structural issues of higher deficit and higher debt in the US is not a good background for the bonds to be freshly bought. So the bond market, apart from oil, is what I'll be watching very closely. And of course, on the dollar, it remains relatively strong. Yen is leading its strength, although euro is also now failed many times to stay above 1.17, although the drop has not been much. But I think this could be due to some month-end demand, and as we turn into a new month, possibly euro can drop back to 1.16 or slightly below that as well. So overall, there is an atmosphere of strength in the dollar. We have a host of data releases today. The weekly jobless claims and Q1 GDP first estimate, then PCE inflation, as well as the personal income and expenditure. That is very important for overall health of the economy to be assessed. So market will be eyeing on that. Of course, we will also be very closely watching the ECB and BOE statement. Both are not expected to change the rates, but their statements on forward guidance, again, whether they will be more clear in their forward guidance, I'm not very sure, as they themselves are not sure where the inflation is headed or where the oil prices are headed and how long they will stay higher. So there's a lot of vagueness in the monetary policy direction going forward. Now, as for the rupee, yes, we hit a new all-time closing high at 94.85, and that is not surprising as oil rose to new cycle high at 122. The pressure on the rupee continues due to persistent demand, outflows, and lack of supplies. And it's only due to some sustained selling from PSU banks, perhaps on behalf of RBI, that it has been able to stay under 95 yesterday. Cannot be sure that it will stay under 95 today as well, because oil prices are higher, dollar is also stronger, yields are higher. There can be a sell-off in the bonds in India as well. And we all know that eventually we are going to get uh, domestic fuel prices going up, and that's going to add to our inflation as well. Now I am looking ahead to how long RBI will keep selling the dollars to protect the 95 levels, or whether it will be let to move today itself, and also whether any policy moves from the government or RBI is on the horizon, just so as to keep the further weakness in the rupee under control, because it become very important, because when the commodity prices are lifting the inflation, rupee's weakness will be definitely adding to it, and policymakers will have to take note of it, and perhaps come out with some more workable measures, unlike what they introduced in early this month. So markets are in a very interesting stage. So we both the rupee at the all-time high, oil at a new cycle high, and of course the bond markets looking very, very fragile. Thank you.
Thank you, Jake. And yeah, very, very tricky times for monetary policy. Lot of uncertainty. On one side, we have got inflation related fears due to this energy crisis triggered by the US-Iran war, which, by the way, does not seem to be subsiding at all. Oil has now hit the new cycle high, breaking when the fighting was actually going on. So essentially, even though there is a so-called ceasefire, things are worse than before, and that is what is keeping monetary policy also uncertain in their language, whether it is US, Japan. I'm pretty sure we'll see that from ECB and BOE also. Even RBI is facing that challenge, so it's very tricky these times, and that's reflected in bonds. All the 2-year, 10-year in the US has gone up by 8 to 10 basis points. And so in other countries, that trend is very similar. Bonds are being sold off, yields are going higher. And that's a very strong, important trend to watch out for. Dollar remains relatively strong. Euro is unable to hold 1.17. Rupee, of course, against the dollar, we are quite weak, almost near 95 rupees now. The rise in oil prices, lack of flows, it keeps driving the rupee weak. How long the RBI will keep selling dollars to support the rupee needs to be seen. So yeah, overall tricky times ahead. We'll keep you updated with the latest in the financial markets. Thanks for listening. We will catch up next week with the latest updates.